welcome everyone to today's seminar. For those who have been following along in this series, you'll know this is webinar number 4. Just going to take a moment to remind you that of the journey we've taken so far through the series. We started webinar 1 with an overview of the task of tackling your contract, how to read a contract like a boss. And we talked about some of the techniques you can use to really come to understand, come to grips with what you may be asked to sign as your contract. And then we moved along to dive into more detailed subject areas. The first being, what is it you're to do under the contract? What's the scope of the work? What are the tasks you have to perform during your contract? That was the first detailed webinar, number 2. And number 3 was about schedule. All things to do with timing, the timing of your work and what happens if there are changes in the work, how do you adjust the schedule? And of course, delays and delay claims. We talked about that in the third seminar. The next logical topic would be price. What is the contract price? What are you going to get paid for the work? How do you go about getting paid? Invoicing and those types of topics. Well, that's going to be the topic for the next and final seminar in the series, webinar number 5. Today, we thought we'd fill in a very important gap in the discussion that's as critical as the other topics. And that is the discussion in the contracts about other types of risk allocations. How are risks in a project dealt with under your contract? How are they insured? How are they bonded? Are there risks that you've agreed to indemnify against? Those kind of topics. So for that purpose, we've assembled a panel today to take us through what contracts say about these types of topics. Now, 2 of the panelists you'll be familiar with if you've been following the series. I'm going to ask each of them to introduce themselves. First, maybe Geza, just take a moment to tell us about your background.
Thanks, Glenn. Hello, everybody. Geza Banfi. I'm a construction lawyer, counsel at the Toronto office of Macmillan LLP. And I've done a lot of this and sit on CCDC and give a lot of talks, and pleased to be here.
Thanks, Geza. And another face many of you will be familiar with from past webinars in this series is Frank. Frank, just remind us your role and background.
Yeah, so Frank Valletta, I'm with Trisura Guarantee Insurance Company, Vice President, National Surety Risk Management. I'm an engineer by training, and I've, before this particular role in surety risk management, I was involved in surety claims for about 30 years. So.
Okay, thanks, Frank. And I'll just take a moment, actually, before I introduce our newest panel member, to let you know that I'm Glenn Ackerley, partner at Weir Folds in Toronto, and I chair our construction law practice, dealing with both contract matters and disputes that arise on projects too. So with that, I'm going to turn it over to Greg to tell us about where you come from. What's your background?
Hello, all. So our company, my name is Greg Petrella. Company is called Petrella Winter and Associates. We're 43 or 44-year-old an insurance brokerage firm. We specialize exclusively in the construction space. So half of our business is bonding for construction contractors, and half of it is insurance for construction businesses. And I've been in the business for exactly 29 years. And it's basically all that we know. We don't insure restaurants or law firms, as you know. All we do is handle construction contractors. So 24/7. That's our area of expertise.
Well, thanks, Greg. It's great you could join us today, and appreciate having your perspective on these issues. And on that note, let's begin by calling on you, Greg, to tell us about one of the topics we want to address today. You'll see the slide has come up to address insurance. As we know from any of the reviews of the contract that we've been urging you all to do, there's a section about insurance. And often we get very, I think, intimidated by that section because it's complicated, it's technical, it's not something that most of us who read contracts have a lot of experience with on a daily basis, at least. So let's take a few minutes and talk about insurance in the construction contract context. And Greg, as I say, if you could lead us off, maybe walk us through what insurance is all about here.
Sure, okay. So I'm looking at the slide here to my left screen, and I'm going to try to follow that a little bit. So slide number 1 kind of asks the question: what kinds of risks need to be covered by insurance, presumably, to the degree possible? Who's responsible to procure what insurances? And the balance of the slide is a little bit of a drill down in those two respects. So maybe I'll start to talk a little bit about what risks need to be covered and who's supposed to be covering them. So essentially, without this being an insurance 101, it is important to drill down a little bit. So I'll say that, construction insurance or commercial insurance in general, but insurance with respect to construction contracts falls into kind of two categories. There are first party risks, where a party will purchase insurance to protect their own property, such as your own equipment or your own vehicles, or damage to the project itself. That's considered a first party coverage. And then there's third party coverages, third party liability coverages, which is where a party, contractor, will purchase insurance to protect them against injury or damage to third parties, like damage caused by your work, or damage caused by your vehicles, or injury caused by your heavy equipment, etc. So you kind of have these first party risks, which is to tangible property that you want to look after, and third party risks, which is your liability to third parties, principally for property damage and bodily injury. And construction contracts recognize the rather complex nature of the question of ownership of materials and equipment during the life cycle of a construction contract. Who owns materials that are being delivered to site, that are on site, that are half installed, that are installed but yet not turned over upon completion? So there's some nuance to the question of ownership there, and therefore how does one ensure that? And the construction contracts also recognize that there are common interests between the multiple parties on a construction project. There's common interest between the owner and the prime contractor in ensuring a building under construction. And there's common interest between a prime contractor and subcontractors with respect to risks on construction projects. So recognizing those two facts, a construction contract, a well-designed construction contract, and most CCDC contracts are, I would say, well-designed, they seek to achieve a kind of a collection, or a broad collection of insurances, and they will specifically designate certain procurement responsibilities to the most appropriate party. So it might be the owner that is in charge of procuring certain policies and coverages, and it might be the prime contractor whose responsibility it is to procure a certain policy or policies. And it could also fall to the subcontractors, each of whom have different insurance responsibilities depending on the form of contracts. So this slide that I presume people have access to or looking at lists the various and typical forms of insurance you will find in a construction contract and on a construction project, the type of risks that you'll want to insure. And those that are highlighted in red are coverages which, first of all, can be purchased or procured by various parties denoted by the contract. And there are also coverages that can be purchased for either a loan party, a loan participant, such as a subcontractor or the prime contractor or the owner, or it could be the kind of coverage that can be procured for a collection of contractors and subcontractors, including the owner, for instance, on one policy. So point being that the contracts themselves, the prime, the subcontract agreements, the supplementary conditions inherent in a contract will tell you who is responsible for procuring what insurances. So I think that's everything I have to say on that particular slide anyway.
One question before you address the remaining questions on the next slide I had for you is just in terms of what's noted here is general liability. Can you help us just understand, because we sometimes hear, I guess, two terms that I wanted to run by you. One is, commercial general liability or something. Is that what we're talking about here? Or the word commercial is often, I've heard, attached to this term. Is that your experience?
Let me address that. So there is a form of insurance policy. It used to be called the comprehensive general liability policy.
Yes.
They decided that was too broad a sounding document. So they changed the term about 35 years ago to commercial general liability policy. And it is what almost every business enterprise would be carrying. And it's a policy that covers their operations, the risks associated with visits to their premises, risks associated with their operations outside and so forth. And that is called the commercial general liability policy. The reason we have here general liability on this slide as opposed to commercial general liability is because remember what I said earlier, which is sometimes you can have a policy cover not just any designated entity, but a policy could be designed to cover multiple entities. In other words, while every subcontractor is carrying a commercial general liability policy, every single one is carrying one. You're not getting into a job site without one, including the prime and the mechanical and electrical, roofing, structural, excavator, etc. That policy follows those contractors run on every single project they're working on and covers and will protect them on all their projects. Some projects say, you know what, instead of having every subtrade carry their own insurance on this project, project is significant enough, large enough, risky enough that we're just going to want one policy, and we call that a wrap-up liability policy. You might have heard that term. We want a wrap-up policy on this project, and that will cover the prime contractor and all the subcontractors. So there's no finger pointing as far as whose liability it was that caused the damage. And we know definitively, we don't have to follow up every year to make sure the subcontractors renew their insurance on this project. We just know that this particular project has a policy designed to cover all parties on one project. And that's why that particular policy is called a wrap-up liability policy. The other is called a commercial general liability policy, and either one will work. The CCDC documents allow for the exchange of some of those policies. Both can work.
Great, thanks. Well, let's move to the next slide and talk about what risks are covered and Greg, what risks aren't covered that you should keep an eye out on when you're looking for you're looking through the contract and what it says about insurance coverages.
So, generally speaking, a commercial general liability policy or even a wrap-up liability policy and collections of the various policies that might exist on a project. Generally speaking, insurances will not cover financial damages, financial losses, which are not a result of an underlying incident, an underlying property damage incident, or an underlying bodily injury circumstance. Since most of those financial losses are really considered by the insurance community as being business risks. In other words, uninsurable risks. That's the business risk you take to be in the construction business. So scheduled delays, financial losses resulting from non-performance of your contract, those are not insurable. I wish they were. We I'd have retired long ago, but they're simply not insurable. And while these policies will cover most accidental and unforeseeable kind of occurrences, no insurance policy wants to work as a warranty of a contractor's workmanship and product and work. Right. So all of the policies, whether it's the liability policies that covers you for damage or to property, or whether it's a builder's risk policy that's insuring the building under erection under completion, none of the policies or rather all of the policies are very carefully worded so that they really don't serve to provide any coverage for the making good of faulty workmanship. And that's because insurance does not want to encourage shortcuts, and it doesn't want to act as a warranty, where a contractor can rush through the project knowing full well that, you know, if it falls apart and it doesn't work, they'll get paid to build it twice. So it's an uninsurable, again, it's an uninsurable risk. So that's simply put in terms of, you know, what's covered and what's not covered. Unforeseeable circumstances that are generally beyond the control of the entity, that are accidental. That's really the spirit and the intention for insurance coverage.
Now, you've talked a bit about how policies may be structured where they're the benefit of the particular individual party or for a group of parties. But how long are the policies on a construction project put in place? How long do they last?
You go to the contract again, because and it's a good question. I know that really the theme of these series of sessions is really about understanding your contract and the insurance provisions in the contract. It should be there. So we need to look at the prime contract. We need to look at the, if people are familiar with the CCDC 41, it's a series of technical specifications, insurance specifications that most construction contracts will refer to, including the CCDC 2, the 5, the construction management contracts, even I think the CCDC 14, the design build, also refers to CCDC 41. So we need to look at the prime contract, the subcontract agreements, the CCDC 41, unless you know it off by heart like we do, and the supplemental conditions, because in those documents you have your answer as to, you know, how long the coverages last, because you know, let's say like some policies will last longer than others, are designed to last longer than others. It'll answer all those questions. It'll speak to deductibles as well. You know, who's responsible for the deductible, right? Because just because an owner may be procuring a policy, or a prime contractor may be procuring a policy that benefits multiple participants, such as the sub-trades, there are deductibles associated with these policies. On a high-rise construction project, it's not uncommon to find $100,000 or $250,000 deductible on either a wrap-up liability policy or on a builder's risk policy, which is the policy that, as you may know, insures the building against physical damage as it's being built until it's turned over. So those deductibles of $100,000 or $250,000 or more, the responsibility of those deductibles is buried somewhere in all of these contracts and or supplemental conditions. And very often it's the prime contractor holding the bag. Sometimes it's passed on to the subcontractors. Sometimes the owner takes that responsibility in certain construction management contracts. So be very careful, because those deductibles get amended, and that can impact the risk of the prime contractor and the subs, who are usually responsible for damage if they cause damage on a project site.
Well, that's very important then, to be looking for the amount that's not the first few dollars that aren't covered by insurance. It might be a lot of dollars. So you have to spot that and see who bears that initial portion of the loss directly. And then the final thing on this slide before we move on topics is insurance relating to design. How do that crops up?
Well, generally speaking, if it's a pure construction contract, there isn't any design responsibility embedded in the contract. In a design build contract in the CCDC 14, that's a document that has incorporated not only as a contractor or the design builder in that case, they're called the design builder in that case, responsible for the construction, but they're also responsible for the design, and they have contractual responsibility for the design, and very often a design builder will subcontract all the design. It's more common that way than it is for a design builder to have in-house design, architect and engineering teams. So usually they'll sub out, you know, the architectural and all the sub-consultants, electrical, mechanical, geotechnical, structural consultants. But that doesn't make them not responsible for it under contract. They're fully liable and responsible for the design under a design build contract. And thankfully, the design build contracts require a certain other insurance, which is not typical in other construction contracts, which is professional liability, which is designed specifically to attend to, and it does a pretty good job, but not entirely thorough job at insulating and insuring against design-related risks that the design builder is assuming by way of their contractual assumption under the contract.
I'm going to just pose, for everybody's benefit, you're invited by CCA to post questions in the Q&A feature here on Zoom. Some will try to address at the end, but if there's a question or two along the way that fit with the topic, I'm going to suggest we try to address it as we go quickly. Just on the question of the deductible, there was a question, can you insure your deductible? Will somebody give you insurance for your deductible, Greg?
Well, does this come from a subcontractor or do we know?
It's not clear. No.
Okay, so generally speaking, well, there's no purpose buying a policy that has a high deductible and buying another policy that buys down the deductible. So usually there's a party that wants to buy down a lower deductible that is the beneficiary in one of these group type of policies, right? So
right.
I'm presuming this might come from a subcontractor. So this is a tricky question. So I just have to elaborate a little bit on this. So there are two principal forms of insurance policy on a construction project that might benefit and include all the parties in such coverage. One of them is the builder's risk policy, right, that insures the building under construction. And one of them is the wrap-up liability policy that covers physical damage, injuries on a job site, a pedestrian being injured by a nearby construction accident or whatever, and property damage to the project once it's complete and turned over. Okay, so those are the two. On a wrap-up liability policy that an owner or a prime contractor may purchase for the whole team, and they may procure it with a deductible of $100,000 or 50 or 100,000, as opposed to 5 or 10, which is typically contractually required. Subcontractors can, on a blanket basis, arrange for coverage for those sort of deductibles, because what will happen is there will be a leak and that leak will cause damage to carpeting, to drywall, to flooring, to maybe electrical apparatus and whatever. And the builder's risk policy, this is during the construction project, the builder's risk policy or the wrap-up policy, one of these two policies will pay for the damage, and then somebody will be responsible for the deductible. And it's usually going to be the party who was responsible for the damage. So that's probably going to be your roofing contractor or your plumbing contractor, whomever, or whoever drilled the hole in the pipe. And so they're going to be responsible for that deductible. On a wrap-up policy, the subcontractor can build into their own annual policy coverage for those deductibles up to a certain amount, maybe up to 50,000, maybe up to 100,000. So they got to keep an eye on what is the wrap-up deductible. First of all, did I build in that coverage into my policy? And if I build it in, what is the maximum deductible that it will help me insulate? So it is doable. It's way more difficult to do on builder's risk policies, okay? So, okay. And frankly, that's where a lot of the bigger exposures exist. So, to our water damage example, where, the building is 3 weeks from being finished and you have a $250,000 water incident because something burst or hit or was ruptured or was hit, there's going to be a large deductible there. And that's very tricky for a subcontractor to insure that deductible. It's doable. We actually have wording that we built in. It takes a lot of negotiation with the right insurance companies to get that. So it's technically doable. It's certainly not commonplace.
Okay. Well, I think there's some more questions getting deep into insurance and coverages and waivers of subrogation and so on. I think in the interest of time, we're going to move on to the next topic, unless Geza, Frank, anything to add on insurance?
No, not really.
Okay. Well, then let's go to the other important topic that comes up in contracts. And I'm going to ask Frank to lead off here, and that is the topic of bonds. So we have,
Right.
often they're thought together, and sometimes bonds are mistakenly thought of as a form of insurance, but they are distinct. And so why don't you lead us through the topic of bonds so we can contrast them?
Yeah, quite right. So bonds, not insurance, right? Keep that in mind. These are rich topics. And I think the best we can do is try to leave you with some concepts, some messaging, and some encouragement in terms of where to find information, because there's just a lot to say on all of these topics, bonds being one of them. And in my career, I've spent way too much time thinking about bonds, so I have a pretty deep understanding of how they work. So, I mean, why do bonds matter? I'll give you my view. Bonds are a key factor in de-risking and therefore enabling the competitive bid process. So if you want to have a competitive bid process where you're an owner and you want the ability to pick the low bidder and not have to worry about the low bidder not being able to complete the job for all intents and purposes, right? If you get a bond with that bid, then that helps you make that selection freely, as opposed to having to come up with some other way to reduce your risk of engaging a contractor that might not perform. So the contract security requirements, as Glenn mentioned very quickly, they used to be together with the insurance requirements, and then CCDC has split them off, and they can now be found in Division 00. I think that's correct, right, Gaza? Division 00 of the specifications, and it's fairly in-depth description of what security is required for the contract. And I invite everybody to look there to make sure that they understand what kind of bonds are required for that specific job. And I would also encourage listeners to make sure that there are any statutory requirements, like for example, in Ontario, about certain bond forms to use, that they become aware of those requirements, because those are also important. Subcontractor bonding is an interesting topic for me, being in the bonding business, because that's usually or often a requirement that sureties will say, hey, listen, you've got some key subcontractors, you're a contractor, you want us to support you on this job, but we really think you should go get bonds for some of your key subcontractors. The reason being that the default or non-performance of a key subcontractor on a major project can be catastrophic in terms of schedule, in terms of impact on other subcontractors and other sub-trades. So you want to make sure that there's some sort of security to ensure that you're not taking a big risk with a key subcontractor. And so really, that's often surety companies will say, listen, we would like you to protect yourself against this potential loss by asking your subcontractors to go and get bonds and deliver bonds to you. Now, there are some specific bond forms around subcontractors that have been designed, that are on the market now, that operate a little bit differently than a performance bond that you would give to an owner. And they are geared towards quick response and minimal disruption to the project, because that's the last thing you want as a contractor. Is if you got a key subcontractor who, for whatever reason, is not performing, you want to keep that job moving. The last thing you want to do is have things stop. So I'd encourage, if there's a requirement for subcontractor bonding, that you go and look at some of the forms that are available out there that are really better products specifically for subcontractors. Any comments, Giza or Greg?
No, good advice.
I would just, yeah, I mean, what we're seeing out in the business right now, it's just a tough circumstance. There's a lot of complications, a lot of conflict, supply chain issues,
right.
and poor suppliers, are dealing with the best they can. Subcontractors inheriting these risks and issues from suppliers, passing it on to prime contractors. There's a lot of angst in the industry, and I think that a lot of contractors are really looking very carefully at their subcontractors and considering use of bonding their subcontractors at this stage just because they got a lot of work on. It's not going nearly as efficiently and effectively as it has in the past. And it's creating a lot of strain in the business. And so, it's a good insurance policy, I guess, against one of the biggest risks on construction contracts, which is the failure of a subcontractor, which has a massive impact on the project. So agree.
All right.
A question for Frank, though, where you've got under the prime contract an obligation to provide bonding. Does it make sense to require bonding at the subcontractor level? Aren't you duplicating the level of security, the level of contract security? Or should you just, should you have bonding only at the prime level or only at the sub level, but not at both? Because somebody has to pay for this, and that's the owner.
Right. Yeah. Well, that's a layered question. But as a contractor, we're talking about a contractor submitting a bond to an owner, guaranteeing to the owner that the contractor is going to do its work. Now, the contractor is guaranteeing with that bond that they're going to complete the contract. But now they have subcontractors in the background, which they don't often control to the extent they would like to. And to make sure that the contractor can fulfill its obligations, it also needs, I think, to get some sort of a guarantee from key subcontractors that they're going to perform their obligations, because the default of a key subcontractor can very easily cause the default of a general contractor, which could result in a call on the general's bond, right? So you got some layers there, and this is all about risk mitigation. So yes, all this stuff costs money, insurance costs money, but the value they deliver is that, as with insurance and with bonds or any other product that is a risk management product, there are many things that can go horribly wrong on a construction project. And these products help you manage your business so that you can absorb or deal with some of these things that go horribly wrong and not end up hitting a wall if something does.
Okay. Just before we move to the next slide, Frank, a question came up about, in terms of subcontracts and requiring subcontractors to provide bonds for their work for the reasons you just explained. Right. From your experience, what level of bond security is typically provided? Is it similar to what the general or provides to the owner under the prime contract, or 50% of the, in this case, subcontract value, or some other number?
It's 50% of the subcontract number.
Okay,
that's the general rule of thumb.
But can I just add to that one? Because, I'll tell you something. In the United States, you know what the common bond spec is? When I say common, I mean all the time. It's 100% performance bond and 100% payment bonds. And so what we've done in Canada, going back 50 or 75 years, is we've kind of said, well, do we really need 100% performance bond coverage? Do we need the bonding? Is it, if we have to turn over the project to a bonding company to complete, is it going to cost the bonding company 100 cents on the dollar, 100 more cents to complete that project? And so our tradition in Canada is generally 50% performance bonds, because most construction defaults and failures end up costing the completing contractor or the owner, if he doesn't have a bond, or the bonding company, 30 or 40, sometimes up to 45% of the contract price. So on a $10 million construction contract, if that contractor goes bust, it's probably going to cost somebody $3 or $4 million. So that's less than 5 million, which is a 50% bond. So it seems to work. But with certain owners, there are certain owners in the GTA, for instance, that have 100% bond spec, and certain projects that are considered trickier or riskier projects that might have 100% bond spec. And some general contractors may require 100% bond from their subtrade, even if they're only providing 50% to the owner, because they're really concerned that this particular subcontractor, man, if things don't go well, because of the complexity of that subcontract, and the availability of other subcontractors to fulfill that work, that I might need 100% bond as opposed to a 50. So it really is just a call based on the risk tolerance of each entity. But agree, like 90% of the time it's just 50% tick mark, right?
Greg, I'm sure you'll agree. It's very situational. Like, for example, if you have an electrical subcontractor doing whatever electrical work or instrumentation work where there's wiring involved, and there's the job stops halfway between when the wiring is completed, and nobody can guarantee that this wire leads to some other location when you connect it up doesn't work. So often those jobs have to be redone from the start, right? So you can't, there's zero value to any of the work that had been performed by that electrical subcontractor, until they stopped working and you had to get a new guy in there. New guy often would just say, no, I need to do this whole thing over again. So that's when the value start of 100% starts to come into play, when the risk is very high that you're going to get a high completion cost relative to the work that's already done.
So we're going to talk now about one other aspect that's important as you're reviewing your contract, and that's reading what the bond also requires. But just before I do, I did want to mention, we're talking about 50% versus 100%. Just remind those in the audience that in Ontario, as part of the Construction Act changes that were made few years back, a new form of bond was ended up in the regulations, and the statute requires that it is indeed a 50% performance bond and a 50% labor and material bond that are to be issued with every public project, every public sector project, using this form that's in the regulations. So it's quite regulated now, prescribed. It doesn't mean you couldn't ask for more, but the minimum now is 50% on all projects that are public projects as defined in the Act. So let's just talk about what you go looking for in these two bonds. Just quickly, Frank, when you're reviewing the contract and also looking at the bonds that are required as part of them.
Right. So the bond requirements in a contract will usually specify the type of bond, right? So in this slide, we're looking at performance and payment bonds and key considerations when making a claim under each, right? So they're almost identical points, right? Except for one point under performance bond, which is default. It's got an exclamation mark behind it, which is important. It's very important to understand how default works in a contract and how it works under a performance bond claim. For example, it's not every default under a contract that would entitle someone to make a claim under a performance bond, right? I mean, the wrong color carpet, or the paint color being wrong, or whatever problem that might be technically a default under the contract, but for which there is a remedy within the contract itself, wouldn't get you a performance bond claim. You really need something that's material in terms of a default where there's no remedy in the contract. And that's an important point that you really you need to go get some help on from a professional who can guide you through what is kind of the default that would be a claim under performance bond and what isn't. But what is common between those two is notice and compliance with time limits. And that's a general theme through a lot of these. When we're talking about contracts, the idea that these sophisticated contracts have intertwined in them a network of requirements for communication, for requirements for notice. Something's happening, you got to tell somebody, you got to tell them quick. If you want to do something, then you got to tell everybody, you got to do something, you got to tell them quick so that they can get ready for it if it's not something they're expecting. That's the same with bonds. There are certain notice provisions, they're in the bond, follow them, track them quickly, and make sure you're within all the time limits to preserve your right to be able to claim under a bond if you ever find yourself in that situation.
Great, thank you, Frank. Anything to add, Geza or Greg, on that point?
Oh, just to reinforce the point, you know, the theme of these seminars is read your contract,
Hmm.
and you know, the bonds are effectively part of your contract, and yeah, when you're in a default situation, you will likely be obtaining professional assistance, and you should, because there are steps you have to follow. But at the front end of the relationship, at the beginning, it's very prudent to just read the bond. You're going to find that they're relatively easy to read. The language is relatively straightforward, and all of the stuff that Frank's been talking about is sitting right there in the bond. You know, the time limits to provide notices, the need for a default and a declaration of default, and so on. And it's all there, and it's good to know that at the front end and record that as part of your project management checklist or template, so that you have it in mind in the event that you do have a problem and you need to enforce the bond, that it's right there and that information is available to you immediately.
That's a great tip, Geza. Certainly, for example, if you're a subcontractor and you're having problems with payment, and we'll talk about that topic, of course, the next seminar. But knowing what your rights are under the labor and material payment, how to know if one exists, how to ask for it, how to make a claim on it, those are the things you should review. I think that's great advice. Okay, well, the final topic or series of topics we're going to turn to now are those clauses in the contract that are a little intimidating sometimes. If you're just browsing through, you can read about what it is you're to do and when you're to do it, how you get paid, schedule things. These are the other clauses at the back end. We're going to just touch on. Geza, maybe you can lead off, because this is that category at the back end, as I say, in the GC 11s, where you come across a bunch of contractual risk allocation and responsibility for different risks that are contracted for. So why don't we lead off with indemnities?
All right. Well, Glenn, you've kind of preempted me, because I was going to begin by saying, speaking of intimidating and complicated and technical, let's talk about indemnity clauses. And I'll spend a minute to trying to simplify it. Indemnity is just a piece of legalese, which means, in basic terms, a contractual promise to cover a loss. That's what an indemnity is. It's a promise to cover a loss sustained by the other party. And so about the practical problem about indemnity clauses is that they do tend to run on, and they do tend to be full of lots of verbiage, and they can be difficult to read. But here are the keys. But before I do that, let me answer the second point: why indemnities matter. You may wonder, well, why do we need an indemnity at all? I mean, the contract has in it obligations, and if a party doesn't perform, the other party has a claim for damages for breach of the contract. Why do you need another contractual obligation to cover a loss layered on top of something that's already there? And there are a couple of reasons, at least. The first is that the first has to do with claims by third parties. So to sort of track an example that's already come up in this conversation, the passerby on the sidewalk who is injured by something going on in the construction site. Something has fallen from the building and injured a passerby. Well, that passerby has a claim at law as against the owner, as against the GC, and as against the trade who actually dropped whatever it is that was dropped. And so from the point of view of the owner and the GC, their interest is in protecting themselves against something that is not their fault directly. It's the fault of the trade who dropped whatever it is that was dropped on the head of the passerby. And they do this through an indemnity whereby the trade agrees to indemnify the owner and the GC against that claim by the passerby, the third party claim. A second benefit to an indemnity is that it performs what might be called a gap filling function. In principle, in theory, there could be things as between an owner and a general contractor. There could be activity that the general contractor engages in or causes or does that causes the loss or damage to an owner that isn't directly covered by the contract. And so what an indemnity does is it picks up that other category of obligations, duty of care, and ensures that if the GC is negligent without necessarily being in breach of the contract, but nonetheless negligent, that the owner is protected via the indemnity. So those are two reasons, among perhaps others, why we have indemnities. So what to look for as you go through the legalese? Basic questions. Is the indemnity was called first party, third party, or both? First party indemnity is wording that says that, again, it's between owner and GC in our example. The general contractor indemnifies the owner against all losses for which it is responsible. Third party language says the general contractor indemnifies the owner against claims by third parties. Both is the general contractor agrees to indemnify the owner against claims for which it is responsible and as against claims by third parties. And in fact, the CCDC standard form language is both. As you're reading it, ask who's being indemnified. And here you see some creative stuff that occasionally causes problems. Obviously, the counterparty, the owner in our example, is an obvious person to be indemnified, but you also see all kinds of other people being listed after the owner as being a beneficiary of the indemnity. The owner, its officers, directors, servants, agents, sometimes the consultant, and so on and so on. And so, read that and just look at that list of people that you're indemnifying and ask yourself, is this reasonable? And because owners will expand that list, people giving the indemnity, the general contractor, an example, will want to contract that list. What is being indemnified? And again, here you see often a very long and verbose list of duplicative language that people like to stick in. All claims, demands, actions, causes of action, losses, damages, expenses, and so on and so on and so on. And that's fine, except when the language starts to get very, very broad and very, very vague. And you see this commonly. So look for unusually broad, unusually vague language in terms of the scope of the indemnity. And just to highlight that, you're probably going to get advice on this, but just to highlight it so that you know what to look for. The interest of the person giving the indemnity, the GC in our example, is obviously to narrow that what is being indemnified to something that is commercially sensible. Okay. And finally, the obligation to defend. Look for, in addition to the obligation to indemnify, indemnity clauses often begin by saying that, again, to track our owner GC example, the GC agrees to defend, indemnify, and save harmless the owner from, and so on. That word defend is loaded with meaning and potential problems. As a practical matter, the obligation to defend includes, as you'd expect, the obligation to hire a lawyer, hire experts, and defend, potentially through a trial. That could be a very expensive proposition for the GC or indeed the GC's insurer. And there may be complications in terms of whether or not the GC can insure, and perhaps Frank and or Greg can speak to this. That obligation to defend may not in fact be insurable. So be alert to that, you're picking up an obligation that may be unreasonable in the circumstances and also not insurable. There are other considerations involving the obligation to defend when one pushes back against, say, an owner who's looking for this. The question is to ask the owner, are you really sure you want us to do this, owner? Because your interest in any claim may be different than ours, the GC's. Furthermore, if I'm the GC and I have an obligation to defend you, that means that I get to pick the lawyer and I get to pick the settlement strategy and the litigation strategy. And you sure you want that? That's the kind of conversation about defend. So it's just a heads up to you. Go ahead, Glenn.
Well, I was just going to say, so we've got a couple more of these topics to touch on before in the time we've got. There was a question posed about who beyond the owner proper might you seek to strike out as an extended indemnity, I guess, if there's typically one. I don't know what your advice would be, Geza. I'm sure if they keep adding in the list more and more remote players, there's a point you say, I'm not going to indemnify all these others. The issue of indemnifying, for example, the consultant, you mentioned that in passing, that's an interesting topic, but maybe the best advice in all of this is to get to sit down with somebody and get advice on what makes the most sense in the circumstances as we go through these.
It depends on the project.
Yep.
And it's hard to give a definitive answer to how extended that list should be.
All right. Well, a couple of other topics that are dealt with in the standard form, certainly the CCDC contract, we're just going to briefly touch on. The next one is waiver of claims. And maybe, Frank, you can just touch on this. What's a waiver of claim? This is language that's in the contract, very complicated language in the standard form, but what's the object of this? What are we trying to achieve through a waiver of claim?
Well, so in my read of the section, the thing that sort of jumps out to me in my head is that the phrase "nothing lasts forever." So at some point, the parties to a contract are going to want to close off their exposure to any bad news that might happen on that contract.
Okay.
Finish the contract. I want to be done with it. So when am I done? When am I still on the hook? And this is the section of the contract that deals with that. So timely notice of issues, again, we're talking about notice, preserves your ability to be able to be compensated for extras or for issues or for damages or whatever it is that might have happened in that contract that you may be looking for compensation for. And that works the other way too for any parties looking for compensation. So, and all of this is anchored around ready for takeover, the concept of ready for takeover. So there are time limits around giving certain notices before ready for takeover, and once ready for takeover happens, the time limits change a little bit. You just got to read this. The instructions are pretty clear. There's just a lot of instructions. So really what you want to see out of this section is when are you off the hook, and what can keep you on the hook for a longer period of time than you expect. All of this stuff is in there. Stuff like, for example, one thing that's listed as toxic and hazardous wastes. If there's any issues around that, then you're on the hook for a longer period of time for anything you might have done that you might have been a spill or something. So this is what we're talking about in waiver of claims. When do you get off the hook?
Frank, I couldn't underscore enough a point that you mentioned in passing, very important point you made, and that is notice. Read your contract in this particular topic for when it is that you have to notify the other party in order to preserve your ability to continue to make the claim. Too often, I think contractors just assume, well, at the end of the job, I can add up what my claim is, how long the delay has been, and then submit it. And they never gave the notice that the contract requires them to have given in time. And instead, by contract, by the terms of the contract you just walked us through, those claims are waived, meaning given up. You have no ability to bring them 3-6 months later when you've figured out after the project what your damages actually are, because you never gave the notice at the time that you're required to give about that claim. So that I think is key. Well, then maybe let's turn to the last of these. I'll call it, the sophisticators, spectral, complicated clauses at the end. Geza, maybe you can just take us through the part of the contract that talks about. You're talking about risks and liability and insurance of the liability and bonds to step in and deal with failure performance, for example. What does the contract sometimes say about liability here in terms of exclusions or limits?
All right, we've already touched upon exclusions and limits of liability in previous sessions of this webinar. I'm not going to belabor
Okay.
it. They're generally speaking, they're a good thing because they limit the contractor's risk, and they allow the contractor to price a lower price because he's assuming less risk. So that's the idea behind excluding and limiting liability. There's only one thing in the interest of time that I want to sort of stress here. When reading the contract, you're going to have the indemnity clause, and you're going to have probably an exclusion clause or a limit of liability clause somewhere in the contract. Read the two of them together to make sure that they actually work together. A very common thing that we see is a clause that limits the liability of the contractor to only direct damages and perhaps to no more than $10 million and the value of insurance, assuming it's an insurable loss, et cetera, et cetera. And then an indemnity clause in the same contract that begins with, notwithstanding any other provision of this contract, the contractor agrees to indemnify the owner against everything, without any limit, without any qualification. Well, those two clauses are inconsistent. With the right hand of the limitation clauses given you, the left hand of the indemnity clauses taken away. So that's a common problem. Look for it and deal with it, because you may, in the end, not have a limitation of liability clause if the indemnity clause is worded the way in which I've just described it. So that's all I want to say about exclusions and limitations.
That's great, Geza, and I can agree. I've certainly seen that situation happening where the two parts of the contract are contradicting each other. So that's a great point. So, Greg, to sum up the session today, what are the takeaways that we should be taking away from it?
The takeaways to take away. Well, I would say, guys, I mean, takeaway number one, read your contract, read all the supplemental elements of your contract. You read the contract above you, the contract connected with you. In other words, if you're a subcontract, you probably have many of the obligations inherent in the prime contract. So get a copy. You're entitled to a copy. Read the supplemental conditions. To me, that's where most of our focus is, because we know the contracts, and everybody on this call may already generally know the spirit of the contracts they often engage in habitually, right? So, I mean, our focus tends to be on what have they done to that contract and why. So looking at those supplemental conditions is always, we're a lot more fine focused on those than even the contracts themselves. And I guess, the finally other takeaway is to talk to people like the panelists, here today, your legal counsel, your risk advisor, your insurance broker, risk advisor, your bond consultants, and have open conversations with them, because they've got a breadth of experience. They've seen it, been there, done that, or they've had another customer that's seen it, been there and done that, stepped on the wrong mines at the wrong times that they've learned from, that they can amortize those learnings on helping you. Those
Great.
would be my takeaways.
Well, thanks, Greg. Great points. Given the time, I'm going to suggest we wrap it up there. We don't have any further open questions. But just a couple of things, housekeeping things. First of all, we're going to do a quick poll. Maybe if we could pull this up, just have a look at this poll. There you go. How would you rate today's webinar content? If you could indicate your answer there. And as you're doing that, thank you. We'll have the results in a moment. Wanted to tell you about the next seminar. I've given you a teaser for it already. If we could click, gaze a couple of slides ahead. The next seminar is 2 weeks from today, this is May 15th here. We've got the next one is actually going to be 2 weeks from today, and it is going to be on the topic, as I indicated, about getting paid. So check on the CCA website for the details, the login information. Of course, this is offered to you without charge. We'd love to see you all there at the next session. So that's it for today. Do we have the results of the poll? We'll see if that comes up. There we go. Excellent. Well, thank you very much. That's very helpful. 98% satisfied or very satisfied. So that's good. Thank you for that. And we'll see you all next time for the final seminar on May 29th.
Very good.
Have a great day, everyone. Thanks
Bye-bye.
to all the panelists. Bye-bye.
All right, thank you.